Ingredion could be an interesting dividend stock for 2025 with an attractive dividend. Well, a potential price return and a price treatment that you might be able to benefit from. Ingredion is a company primarily active in ingredients, so they have a number of ingredients by type, but you can also find all the other things on their website. I have a background myself. I also have work experience in starches Pepmol, so I do have some understanding of this market. But basically, Ingredion, the food industry, is sustainable for the long term, always needed, of course, for food. So the population growth is also relevant for that. And right now, it seems like Ingredion is available for purchase around its fair value. In any case, the intrinsic value calculation from Morningstar is 132, or the current stock price is 130, a star rating with limited option for advantage. So the economic moat is referred to as narrow. That's definitely more than nothing, according to Morningstar. And of course, they have a competitive advantage as a company. And the food industry is not really very susceptible to intense disruptive innovation, but you never know. So valuing these kinds of companies is relatively easier. Now, analysts indicate that their price target in the short term is actually higher, 165, due to the current price of Better Is. It means an upside potential of 26%. More interesting, maybe the lowest target is just 147. If we look at the historical valuation of this company and this stock, then we see that for a period of lower prices, the stock price has been rising significantly for a while now. Now we selected it as a dividend stock sometime in 2023. Back then, it was still a lot lower. But now it could be interesting again because, as you can see, the current price is starting to drop again. And that's just it. We're asking how far this decline will continue, but that could become interesting. So at this moment, it seems that we can buy the company or the stock just below its fair value, just below the intrinsic value. But of course, you also want to have a margin of safety. So a bit of patience waiting for the price to drop further could be quite interesting. Why, we'll get into that more shortly. So the price to earnings ratio has dropped to around 12. But the normal multiple for the price to earnings ratio is at 13. In the past, it was a bit higher, but let's stick with 13. Below, we see the analyst's estimate regarding EPS growth. That doesn't look excessively high. Only 6 and 4% growth for head earnings per share is not extremely high. So a multiple of 13 seems to be in line with everything. Well, then the potential return could be, on average, almost 12%, including a return of about 2.5%. Sounds realistic, but it could also be that it's a lower multiple. At 10, there is no cow yield. And the EPS estimate can, of course, also go wrong, but it could also be a bit higher. Now, why is the ingredient possibly still interesting for both the short and long term? The factor analysis indicates that it's a strong buy. We can see that here. This is an algorithm that I personally have had a positive experience with. And by the way, this is seeking alpha discount link. We are offering in our description, so check our YouTube description and you'll find a discount link. Can you also try this program yourself? They let you try it for 7 days. And when we look at the valuation, it looks relatively good compared to the sector. Well, it's also interesting to see that here you see the price to earnings ratio for next year estimated to be around 12. And the 5-year average of Ingredion is a bit higher in that regard, namely 8. So even compared to its own valuation, it does seem a bit cheaper than usual. Price to earnings of 12. For this type of company, mid's easy is okay, but it can always be cheaper. Maybe it will drop below 10, and that might be possible with the current price drop because the stock market is also starting to decline, so that could really present an interesting opportunity. The PIC ratio is a bit higher than we would like to see. We actually prefer to see that under 1. On the other hand, the price to cash flow seems to be okay. There are really a lot of specifics regarding the debts. The debt level is not very low. But they also have significant cash, so in the short term, there seems to be liquidity for solvency. And for the long term, of course, the Monday research is needed to quickly check the balance sheet to see how that development is going and how they are using those debts. Now, regarding growth, that's not very remarkable. Indeed, the e-metal growth for next year is estimated at 11%. If we look at the estimate of EPS growth for the next 3 to 5 years, it's 11%, and that's a bit on the higher side. But we've already seen what the PIC ratio is, namely 1.3. The PIC ratio takes into account the EPS growth for the coming years. The operating cash flow growth is quite impressive, 90%. The dividend growth for this year was 8%, but let's take a closer look at that in a moment. First, the profit margin, quickly, 9% profit margin. That's not great, but it's just average. And it does mention sector median here, but there are also quite a few other types of companies in this sector. I've already told you, I have experience in this market, the food industry, and a 10% profit margin is kind of the target that most companies want to achieve. So that's just in line with the industry. Return on equity is quite high at the moment. The 5-year average return on equity isn't too bad either. It's still a little surprising. Return on total held capital, 10%. The 5-year average is at 8%. As a pre-investor, you would obviously want to see higher performance. So I'm not going myself either. Investing in ingredients. As far as I'm concerned, there's just a bit too little good potential as a company. Also not unique enough, by the way. And yes, also in terms of profitability. It's not that it's a super high profit margin, and it's also not significantly higher than the sector median. And of course, if it achieves higher profits than its competitors in the very long term, then it will outperform. That's why quality investing, in other words, high quality stocks, you often recognize them by the combination of high profitability and an increase in high return on equity and return on invested capital. We're really talking about this. Dividend stocks. Companies that consistently pay dividends are, of course, more in the maturity phase, so a bit less growth, and that makes sense, of course. And that's why we assess these types of stocks based on different characteristics, and specifically whether the valuation, at least the current valuation, is okay, not too high. For Giri, that seems to be the case. The 4-year average dividend is 2.7%. For the rest, the estimate for next year is 2.4%. What is disappointing about this dividend stock is that it doesn't achieve much dividend growth year over year. It's actually been interrupted, but what they do is pay dividends for 20 years in a row. Just a little longer, another 5 years, and then they are a dividend aristocrat. Do they belong to a nice list of dividends? Aristocrats. At Albadol, the dividend growth is not super, so not really a dividend growth stock, but they are doing relatively well. That benchmark yield isn't super high either. 2%. Albadol seems to be doing reasonably well here. Well, when I'm not on the very high side, and that's a bit of it, due to the recent price drop, over the past few months, the stock has fallen by 13%. That's quite significant, you would think. I think it might drop a bit further, because the entire stock market is currently declining. What would be really interesting is if the stock drops to around this level of 110. That sounds very low, but a smart investor often takes that. Still, time is on your side, and maybe you'll get lucky. That actually means a decline of 26% compared to the last peak, or another drop of about 10 to 15%. And for the long term, you can see that there is generally some growth, but also some phases with quite significant declines. So the volatility, which you would expect for a dividend stock, isn't there. But here you see a 50% drop, of course, during the financial crisis. However, here in 2011, there wasn't really anything special. The stock has fallen by 35%. So that's probably based on quarterly figures. You also see a very rapid decline, by the way. It does drop here and there by 20% or more. And, of course, 2018 comes along with, for example, 2020. So, yeah, a bad negative trend, also combined with a crash in the stock market, has led to a 53% drop. Well, I think that's quite a lot for the current situation, but never say never. So I would be patient here and wait until it either drops to this level, either the price level of 110, or maybe even further down to the price level of, for example, 100. But all in all, Ingredion seems to have a good chance of success with an attractive share price potential. And these estimates can always change from time to time. That's the downside to these estimates. So the best thing you can do is to do your own research on the company and its competitive position. Do you want to know what we consider the best dividend stock? Do you select every month? Then take a look at our website. Happy Investors for Dutch or international is businessinvestors.info. And what you get then is a 30-day trial period. Try it out. And with HappyVest, it's a 14-day trial for €1. Every month, a dividend stock that we believe has potential for the long term. That's a monthly overview of top dividend stocks. And of course, you can also choose other chains for the bundle discount. but that's not what you're here for. All in all, I think Ingredion is interesting as a dividend stock for the long term, but I would be patient here for a moment, and possibly with the help of MR Market, then the price will drop further, and we can buy ingredients at a better price with a margin of safety.